Imagine waking up one morning to discover that every dollar in your bank account is worth 20% less than it was yesterday. No bank robbery, no stock market crash, just silent erosion of your purchasing power. This isn't a dystopian fantasy. This is inflation, and it's happening right now, quietly transferring wealth from your pocket to someone else's. Meet Jamie, an average worker who noticed something strange 6 months ago. The grocery bill that used to be $80 now costs $95. The gas tank that cost $40 now takes $52. The rent that was $1,200 is now $1,400. Jamie's salary hasn't changed, but somehow there's less money at the end of every month. Jamie isn't bad with money. Jamie is experiencing inflation, the most misunderstood economic force affecting billions of people worldwide. But here's what most people don't understand. Inflation isn't just about prices going up. It's about the fundamental value of money changing. It's about who wins and who loses in this massive invisible transfer of wealth. And most importantly, it's about understanding the complex machinery that either protects your financial future or destroys it. The official story you've been told about inflation is incomplete and sometimes deliberately misleading. Today, we're going to expose exactly how this system works. Sarah started asking questions 6 months ago when her savings account became worthless, not because she spent the money, but because the money itself changed. She saved $10,000 for emergencies. The number in her account stayed the same, but what that number could buy shrank by 15% in just 2 years. That's $1,500 of purchasing power vanished into thin air. Where did it go? Who took it? And why does everyone act like this is normal? The answer requires understanding 3 critical concepts that economists don't want you thinking about too carefully. First, inflation is not a natural phenomenon like weather. It's created by specific human decisions in specific institutions. Second, inflation doesn't affect everyone equally. Some people get richer during inflation while others get crushed. And third, the tools used to measure inflation are deliberately designed to understate the real impact on your life. These aren't conspiracy theories. These are mathematical facts hidden in plain sight. Professor Hayes has studied monetary policy for 30 years. He knows the uncomfortable truth that most economists avoid stating publicly. Every time new money enters the economy, someone gets that money first. Those first recipients spend it before prices rise. By the time that money reaches ordinary workers like Jamie, prices have already increased. This is called the Cantillon Effect, and it's the hidden mechanism that makes the rich richer during every inflationary cycle. It's not luck, it's structural design baked into our monetary system. But before we can understand who benefits from inflation, we need to understand what inflation actually is. And I guarantee it's not what you think. Ask 10 economists what inflation is, and you'll get 10 different answers. Some say it's rising prices. Others say it's too much money chasing too few goods. The Federal Reserve says it's a general increase in price levels. But here's the problem. All these definitions are symptoms, not causes. They're describing what you see, not what's actually happening beneath the surface. Alex, our data analyst, pulled the historical records going back 200 years. The findings are stunning. Before 1971, the average annual inflation rate in the United States was less than 1%. After 1971, it jumped to over 4% annually. What happened in 1971? President Nixon severed the last connection between the dollar and gold. Money stopped being backed by anything physical and became purely a government promise. That single decision fundamentally changed the nature of currency itself. This brings us to the real definition of inflation that you won't find in textbooks. Inflation is the expansion of the money supply, period. Rising prices are just the inevitable consequence. When you increase the amount of money in circulation without increasing the amount of goods and services, each unit of currency becomes less valuable. It's not complicated economics. It's simple mathematics. Imagine if everyone on Earth suddenly received $1 million tomorrow. Would everyone be rich? Of course not. Bread would just cost $10,000. Professor Hayes explains it using the island economy thought experiment. Imagine an island with 100 people and 100 coconuts. If each person has $1, coconuts cost $1 each. Now, imagine a helicopter drops $900 more onto the island. Suddenly, there are $1,000, but still only 100 coconuts. What happens to coconut prices? They rise to $10 each. The coconuts didn't change. The people didn't change. Only the money supply changed. That's inflation in its purest form, stripped of all the confusing economic jargon. But here's where it gets darker. The official inflation measurements, like the Consumer Price Index, don't actually track the money supply. They track a curated basket of goods that can be changed whenever it's politically convenient. Housing costs exploding? Remove housing from core inflation measurements. Food prices skyrocketing? Focus on electronics that are getting cheaper. The methodology has been changed over 20 times since 1980, and every single change has resulted in lower reported inflation numbers. This isn't accident. It's design. Lower reported inflation means smaller cost of living adjustments for Social Security, lower wage increase expectations, and continued public confidence in monetary policy. Sarah discovered this when she tried to understand why her cost of living felt like it was increasing by 10% annually while the government reported 2% inflation. She compared her actual expenses to the official basket of goods. Rent? Up 30% in 3 years. Healthcare, up 40%. Education, up 60%. Groceries, up 25%. But the government's basket included new smartphones, televisions, and computers that were getting cheaper. The weighted average looked reasonable on paper, while Sarah's actual life became unaffordable. The measurement was accurate for the basket. The basket just wasn't accurate for real life. So now we understand what inflation really is. But understanding the definition is just the beginning. The real question is, who creates this inflation and why? There's a building in Washington, D.C. that has more power over your financial future than any corporation, any politician, or any law. It's called the Federal Reserve, and it has the legal authority to create unlimited amounts of money out of thin air. No gold required, no congressional approval needed for most operations. Just keystrokes on a computer that conjure billions of dollars into existence. Director Chen sits in the Federal Reserve Board meeting every 6 weeks. The decisions made in this room affect 8 billion people worldwide. In 2020 alone, the Federal Reserve created $4 trillion in new money. That's 4 million millions. In 2021, another 2 trillion. By 2022, the M2 money supply had increased by 40% in just 2 years. To put that in perspective, 40% of all US dollars in existence were created in a 24-month period. This wasn't a printing press running overtime. This was digital creation at a scale never before seen in human history. Now, the Federal Reserve will tell you they create money to stimulate the economy, to prevent recessions, to maintain employment. And there's some truth to that. But here's what they don't advertise. When the Fed creates new money, it doesn't drop it from helicopters onto Main Street. It uses that money to buy government bonds and mortgage-backed securities from large banks. The banks get fresh cash first. They can lend it, invest it, or use it before inflation catches up. This is the Cantillon Effect in action, and it's legal, systematic, and devastating for ordinary people. Jamie works 40 hours per week. Jamie's hourly wage is $22, which sounds decent until you realize that wage has barely moved in 3 years. Meanwhile, the money supply increased by 40%. Jamie didn't get 40% more dollars. Jamie's employer didn't get 40% more dollars, but the banks did. The financial institutions did. The large corporations with credit lines did. They spent that money bidding up assets, real estate, and stocks before Jamie ever saw a penny. By the time Jamie's modest 3% raise came through, prices had already risen 8%. Jamie isn't falling behind because of poor choices. Jamie is falling behind because of when money reaches Jamie in the economic hierarchy. This creates what economists politely call wealth inequality. But what's really happening is wealth transfer. Assets like stocks, real estate, and commodities rise in price when new money enters the system. People who own these assets get richer automatically. People who only sell their labor for wages get poorer automatically, because wages always lag behind asset price inflation. Since 1980, the stock market has increased by over 4,000%. Real wages adjusted for true inflation have increased by less than 10%. This isn't coincidence. It's mathematical certainty built into a system where money creation flows to asset holders first and wage earners last. Rita owns a small business with 12 employees. She's caught in the middle of this system. Her costs are rising faster than she can raise prices because her customers are people like Jamie who don't have more money to spend. Her suppliers increased prices by 15% this year, citing their own increased costs. Her rent went up 20%. Her employees need raises just to survive. But giving everyone a 10% raise would eliminate her entire profit margin. Rita can't print money. Rita can't borrow at 0% interest like major corporations. Rita has to make impossible choices every month, cutting corners, reducing quality, or passing costs to customers who can't afford them. Small businesses like Rita's don't cause inflation, they're crushed by it. But the Federal Reserve isn't the only player in this game. There's another institution that benefits enormously from inflation, and it might surprise you. If you cannot stop inflation, the next best option is to position yourself on the winning side of it. This is not about getting rich fast. It is about not getting slowly poorer over time. The financial strategies that worked for previous generations no longer work in an environment where the currency is designed to lose value every year. Protecting purchasing power now requires a different approach. The first rule is simple but uncomfortable. Cash is not savings. Cash is a depreciating asset. At 7% inflation, money sitting in a bank account loses roughly half its purchasing power in about 10 years. Holding excess cash feels safe, but it guarantees long-term loss. The shift you must make is moving from saving dollars to owning assets. Keep enough cash for short-term expenses and emergencies. Everything beyond that should be working for you in forms that resist inflation. The second rule is to own assets that rise with inflation. Real estate is the most common example. When inflation increases, property values and rents usually increase as well. If you have a fixed mortgage, your payment stays the same while the value of the asset rises. Over time, inflation reduces the real burden of the debt. For people who cannot yet afford property, there are other options. Stocks in companies with strong pricing power. Businesses that can raise prices faster than their costs. Commodities that have real intrinsic value. Even investing in your own skills counts, because increasing your earning power faster than inflation is one of the strongest defenses available. The third rule is to understand debt correctly. In an inflationary environment, not all debt is bad. Fixed-rate debt on appreciating assets can actually work in your favor. If inflation runs higher than the interest rate on your loan, the real value of that debt shrinks over time. You borrow strong dollars today and repay weaker dollars in the future. This only applies to fixed-rate debt used to acquire productive assets. Variable rate debt and consumer debt on depreciating items remain dangerous. The goal is not to avoid debt at all costs, but to use it strategically. When these principles are applied consistently, the difference becomes obvious. Instead of letting savings sit idle, capital begins to grow. Instead of racing inflation, you move alongside it. Even modest portfolios can outperform inflation when assets are diversified and aligned correctly. The focus is not prediction, it is positioning. These strategies are not shortcuts. They do not eliminate risk, but they dramatically improve your odds. Over time, the gap between holding cash and owning assets compounds in your favor. One path slowly erodes purchasing power, the other preserves it and, in many cases, increases it. Inflation will continue whether you prepare for it or not. The system is not designed to protect savers. It is designed to function under heavy debt. You cannot change that reality, but you can change how exposed you are to it. These strategies will not make you immune to inflation, but they will move you from the losing side of the wealth transfer to the winning side. Now let's bring everything together and look at the bigger picture. Inflation is often called a hidden tax, but that description is far too gentle. Inflation is better understood as a continuous transfer of wealth. It quietly shifts money from savers to borrowers, from wage earners to asset owners, and from people who rely on cash to people who control assets. This process runs every hour of every day. It does not pause, and it does not ask for permission. Let me show you exactly how this mechanism works. Consider Marcus. Marcus is a successful investor with a portfolio worth $3 million. When inflation rises to 7%, Marcus does not panic. He adjusts. Marcus owns real estate that increases in value as prices rise. He owns shares in companies that raise prices faster than their costs. He holds commodities, precious metals, and inflation-protected securities. When consumer prices rise by 10%, Marcus's assets rise by 12%. The numbers in his accounts increase. Each dollar may buy slightly less, but Marcus has more dollars than before. Inflation does not hurt Marcus. Inflation rewards Marcus. The system is structured to benefit people who already own assets. Now compare that with Jamie. Jamie has $11,000 in a savings account earning only 0.5% interest. With inflation running at 7%, Jamie loses 6.5% of purchasing power every year. That is over $700 in real value disappearing annually. Jamie does not own stocks because most of Jamie's paycheck goes to rent, food, and basic expenses. Jamie does not own property because saving for a down payment becomes harder every year as prices rise. Jamie's only asset is labor, and wages almost always rise slower than asset prices. This is not a failure of discipline. It is a structural disadvantage built into the monetary system. Jamie opened that savings account 5 years ago with the hope of buying a home. Jamie saved carefully, cut expenses, and delayed small comforts. 5 years ago, a modest home cost $200,000, requiring a $40,000 down payment. Today, that same home costs over $300,000, requiring more than $60,000 down. Jamie's savings grew from $6,000 to $11,000. The required down payment grew much faster. Jamie worked harder, saved more, and still fell further behind. This is the core engine of inflation-driven inequality. New money enters the economy through financial markets first. Asset prices rise before wages do. By the time wages increase a few percent, asset prices may already be up 15%. The wealth gap is not primarily about effort or intelligence. It is about position. Those closest to the creation of money benefit first. Those furthest away pay the cost. Policymakers are aware of these outcomes, but their mandates focus on employment and headline inflation numbers, not wealth distribution. Official inflation figures often understate the real increases in housing, healthcare, and education. The system measures what it is designed to measure and ignores what it is not. Problems that are not fully measured are never fully solved. The winners in this system are easy to identify. The losers are just as clear. The real question is whether this system can be changed or whether it is now too deeply embedded to stop.
We've covered a lot, so let's bring it all together. Inflation is not what most people think it is. It isn't some uncontrollable force. It's a policy choice with winners and losers. Those closest to money creation benefit, while everyone else quietly pays the price. And the truth is, inflation isn't going away. Stopping it would cause economic pain that no politician is willing to accept, so the cost is spread slowly over time. Experts who study monetary systems agree on one thing. The current system cannot last forever. Either debt keeps growing until a crisis forces change, or inflation slowly erodes purchasing power until trust in money weakens. Both outcomes are painful. Policymakers choose slow inflation because gradual pain is easier to manage than sudden collapse. This isn't a conspiracy. It's how incentives and math work. Here's the empowering part. You don't need to fix the system to protect yourself inside it. Once you understand how inflation really works, you gain an advantage. While others hold cash that loses value, you focus on assets that grow. While others avoid all debt, you learn how to use fixed-rate debt wisely. While others wait for things to improve, you position yourself for any outcome. Knowledge only matters when you act on it. The shift doesn't have to be dramatic. Cash becomes an emergency backup, not a long-term plan. Investing becomes consistent instead of emotional. Goals like owning a home or building skills turn into clear steps, not vague ideas. These aren't extreme moves. They're smart adaptations to the system we live in. The final truth is simple. Inflation will continue. Governments and institutions are not designed to protect your purchasing power. That responsibility falls on you. Being on your own doesn't mean being helpless. It means knowing the rules. Now you understand how inflation actually works. What you do next decides which path you take. If this video changed how you think about money, subscribe and share it with someone who needs to hear this. I'll see you in the next one.